Money and credit money plays a very important role in our daily lives. It is used as a medium of exchange, and without it, buying and selling goods and services would be very difficult. In this lesson, we learn about the role of money, how credit works, and how it impacts people's lives. Money as a medium of exchange. In earlier times, people used the barter system, where goods were exchanged for goods. For example, if a farmer had wheat and needed cloths, they would exchange wheat with a weaver for cloths. However, this system had many problems, like difficulty in finding someone who wanted to exchange what you had. So, money solved this problem. What is money? Money is a medium that is universally accepted in exchange for goods and services. It also acts as a measure of value. Modern forms of money include currency. It is paper notes and coins issued by the government. Bank deposits, money kept in the bank that can be used through checks or digital payments. For example, if you buy a book for Rs 200, the seller accepts money instead of exchanging it for another item because money is accepted everywhere. Loan activities of banks. Banks play an important role in providing money to people through loans. They accept deposits from people who save money and use those deposits to give loans to others who need money. How do banks work? People deposit their savings in banks, which are kept safe. Banks pay interest on those deposits. Banks use the deposited money to provide loans to others and charge a higher interest rate on loans. The difference between the interest earned from loans and the interest paid to depositors is the bank's profit. For example, if a person deposits 1 lakh rupees in a bank, the bank gives that amount to another person as a loan and collects interest. If the bank collects Rs 800 interest from the loan taker and gives Rs 400 interest to the depositor, the remaining Rs 400 is the bank's profit. Credit refers to borrowing money or taking loans. People borrow money for various purposes such as farming, business, education, or medical emergencies. 1. Formal sources of credit. These include banks and cooperatives. They are regulated by the government and the Reserve Bank of India, RBI. They charge lower interest rates. Borrowers must complete paperwork and provide collateral. For example, banks like SBI, HDFC, and Bank of Baroda. 2. Informal sources of credit. These include moneylenders, traders, relatives, and landlords. They are not regulated by any authority. They charge very high interest rates. Loans are given without much paperwork but may involve exploitation. For example, a farmer may borrow from a moneylender when a bank loan is not easily available, but the moneylender may charge a very high interest rate, causing problems for the farmer. Terms of credit. Every loan agreement has conditions called terms of credit. These include 1. Interest rate, 2. Collateral, 3. Documentation, 4. Mode of repayment. For example, a shopkeeper borrowing 1 lakh from a bank might submit property documents as collateral and repay in monthly installments with 8% annual interest. Credit and its impact. Credit can have both positive and negative effects depending on how it is used. 1. Positive impact of credit. When loans are used productively, they help people improve their standard of living or expand their business. For example, a farmer takes a loan to buy high-quality seeds and gets a good harvest. 2. Negative impact of credit. If a borrower cannot repay the loan, it leads to debt and financial problems. For example, a farmer takes a loan but suffers crop failure due to drought, making repayment difficult. Formal sector credit in India. The government encourages people to borrow from formal sources like banks and cooperatives. The RBI monitors these institutions to ensure fair practices. Banks and cooperatives provide credit at reasonable interest rates. Formal credit ensures safety and reduces exploitation. For example, self-help groups take loans from banks at low interest and start small businesses. Informal sector credit in India. In rural areas, informal sources like moneylenders dominate. Banks are not easily accessible, and paperwork can be difficult for uneducated people. Moneylenders charge very high interest rates. Borrowers often fall into a debt trap. For example, a small farmer borrows Rs 5,000 at 10% monthly interest and the debt keeps growing. Self-help groups for the poor. Self-help groups SHGs are small groups of people who save money and give loans to members at low interest rates. They also take loans from banks and share among members. Features of SHGs. 1. Promote savings. 2. Reduce dependence on moneylenders. 3. Empower women financially. For example, 15 women save Rs 100 each per month and later use the savings to give small loans. Grameen Bank of Bangladesh. The Grameen Bank was started by Muhammad Yunus. It provides microcredit to poor people, especially women, without collateral. For example, a woman borrows money to buy a sewing machine and starts her own business. This chapter highlights the importance of money and credit in the economy. It emphasizes the need for formal credit and the empowerment of people through SHGs and microcredit. Thanks for watching. Please like the video. Please share this video with your friends. Please subscribe to Great Booster channel. Press the bell icon to get all the latest updates. Check the description for useful links. Check the end screens for new videos.